Yeah, I mean, it seems pretty incredible, right, Scott, if you think about where we were just a few weeks ago and thinking about the tail on this growth sell-off that we were experiencing. And I think it sort of speaks to some of the things we've been talking about as it relates to what is the true impact of the Fed in terms of raising interest rates. I come back to, if we are indeed moving towards a sustainably lower growth environment, back to where we were in 2018 and 2019, if we are moving into that narrower range of outcomes, if you think about the FANGs, what they offer and afford you are strong balance sheets, free cash flow, the ability to make tuck-in acquisitions, the ability to innovate, and most importantly, the ability to grow their earnings even against a backdrop where they do not have some of the secular tailwinds that we've been experiencing the last 2 years. And I would argue that Joe made a comment a long time ago, and I remember it. He said something about being able to not have a second release of pent-up demand post-pandemic. I actually think that we've seen several smaller releases of pent-up demand here and in China, and we are going to see, as it relates to Apple, continued consumer strength because we haven't had our demand met in this post-pandemic world. And so whether it's enterprise spend or whether it's consumer spend, whether it's Amazon and Apple or Google or Microsoft, I feel like there are still opportunities for us to be able to grow earnings, perhaps not receive the multiple expansion that we've been afforded the last few years. But why wouldn't you want to have these names in your portfolio? And we're seeing that true differentiation between the high-flying stocks that were work from home and real enterprises that can continue to grow against a more uncertain growth backdrop.
Jon Najarian, this move in Apple, I mean, it was the debut day of overtime on March 14th, as I said. Somebody calling me now. And that's when the stock went all the way down. And I said at that point in time, watch out. If this stock breaks down, we got a bigger problem. And in fact, the opposite has happened. As I said, it's pushing $172, $10 from its high.
Yeah, and you heard what Dan Ives had to say. A number of other strategists have talked about this. And I think the issue here, Scott, is that the time to buy, Jim's being a very cautious guy, buying them after this pretty significant rebound. I don't like catching a falling knife, but I do like buying on those big sell-offs unless something fundamentally changed about the story with Apple or Microsoft. Again, two of my largest holdings, and nothing fundamentally changed. Is the war going on still? Absolutely. Is Apple still crushing it? And are they still going to see another cycle heading into this fall? That's what I believe. And that's why, with the stock at 150 or 148, whatever the low was on that day, I think that was the opportunity. Again, you have to be willing to catch the falling knife, or you can wait $20 and jump in at 170. I didn't flush it out when we hit 150. I was adding call spreads, and I'm still in it now, and I'm not taking profits. I think this one continues to work and grind its way higher, and then maybe we get some sort of innovative thing, or the fact that so many more people are using their products, including cloud, means that they're just going to be on the services side, Scott, just crushing it. So, yeah, I think you have to be willing to get a little blood on your hands from catching that falling knife once in a while. But if the fundamental story did not change, that's your reason to buy on those big dips, rather than chasing it after it's made a $20 or $22 rebound.
Well, I don't know if you were in on the same trades that Pete was a day ago, but when he was with us yesterday, he said he had more options action going on than he's had in a long time, some 50 or so trades, and a bunch of those were Meta and Microsoft. And in these large names in technology that we're talking about, he was betting on some near-term upside, and lo and behold, here we go.
Yep. And the same thing was occurring, again, just 7 trading days ago. Tesla was in the mid-700s, Scott. Today it trades into the almost 1050 level. 1030 was just a little bit ago, $1,030 a share. So that's how fast it happens. Same thing with the Chinese internet stocks. They were pouring money into these stocks on that March 8th through March 14th area. That's the time to chase in. I'm not saying that you have to dump them now. I'm just saying that, if you're willing to make those trades, and the reason Pete was trading so many options was he can define his risk when he enters. I was doing the same thing. You trade stocks on that with that same outlook. You're not defining your risk.